Neil Dutta of Renmac, not seeing a reason to wait to hike rates. He writes the following: if you have one good month of inflation data, but you know the next 2 months will be bad, you might as well just do it now. Neil joins us now for more. Neil, provocative piece this week. Appreciate your time and thanks for coming on. Walk us through the setup for next week and why you think tactically this might be the right window to hike rates.
Well, I think following with what Mike said, the sort of checking of the boxes, I mean, I almost feel like, guys, it's sort of hiding there in plain sight in the minutes, right? So you kind of have the AI demand piece. We see that hyperscaler CapEx continues to moonshot. You have the oil piece, and while it's encouraging that oil is down today, I mean, it does feel like the conflict is ongoing, and so I think it's possible that that's fleeting. But we do know that no matter what, gas prices probably go up into August. Lastly, tariffs. The president is doing what the president does with tariffs. So it's kind of, you just go down the list. Now, if you're Kevin Warsh, I think it's important to go hike when you can and maintain some modicum of control over the committee than to hike when you must. I mean, can you imagine a situation where if he wanted to, he could probably get the committee to get on board for a hold in July. By September, he may not be so fortunate. So if you're him, do you really want to have to deal with that? That would make him look, I think, like a much weaker Fed chair. So I think tactically, just give it to the Hawks now. And if the data kind of improve, the war ends, oil falls, you kind of see a renewed disinflation from the housing market maybe, then you can go tell them to pound sand. But, I think you kind of have to fight one thing at a time. And I think the risk reward is, go now as opposed to having to go a lot more later.
Neil, we've known each other a long time. You know how much I enjoy your research. And one thing I think that you're fantastic at, even though you have very strong feelings about a moment, is separating what you think a Fed should do from what you think the Fed will do. I'd love to ask, though, how wide is the spread right now between what you think they will do and what you think they should do? How much daylight is there between the two?
I think the Fed should, to me, I'm more on the dovish side of the consensus. And I think that's because I see a relatively uneven economy that's being sort of held up by one area. People talk about the broadening out in the capital markets, right, John? But do you really see a broadening out in the economy? You don't, actually. If you look at non-AI related structures investment, it continues to remain weak. If you look at residential investment, it's still sluggish. The high frequency data that we have, your own Bloomberg second measure for consumer spending, that's actually quite weak to kick off Q3. So you don't really see that broadening out in economic activity. You see a very uneven economy. And so I think the risk, of course, with aiming policy at one specific area could be problematic because monetary policy is a blunt tool. So if all you're really trying to do, and by their own admission, they'd be raising rates to cool off AI demand, that can exacerbate the stresses in other areas of the economy, like credit sensitive spending, housing as an example. So that to me is why I'm somewhat cautious on them hiking. So it would put me more in a defensive mood if I'm an investor. But as you mentioned, my use case as a analyst is really what do I think the Fed's reaction function is, and I think they're all kind of tiptoeing towards a hike. There's not really anyone in there that's making the case that I just made. And when you think about just tallying up the votes, that to me is important, but it's also important to kind of think about it in terms of conviction. Right? Like folks like Beth Hammack and Lori Logan, they have a very high level of conviction. Folks like Philip Jefferson, Lisa Cook, maybe less so. They I think are like sort of they're price takers, not so much. Logan and Hammack are price makers. And so if they can kind of corral the, sort of pull along the rest of the committee, I think it's possible for them to do so. And that's kind of why I said, strategically, if you see this kind of debate unfolding in the committee, if you're Kevin Warsh, you can kind of see the tea leaves. Even someone like Williams, who Mike McKee said was sort of, signaling a hold, He's not signaling a hold for long, right? I mean, he's basically going to get on board for September. I mean, a bet on no cuts for this year at this point is really a bet that you get continued weakness in inflation like you saw in June. Possible, I wouldn't bet my life on it. And there's a lot of reasons to expect that some of the improvement we saw last month unwinds.
Neil, I am wondering, a lot of people are saying, what will actually a rate hike accomplish? And you're talking about that, given the fact that there still is a very bifurcated economy. That said, some people like Megan Swiber of Bank of America just earlier this hour was talking about how it could cap the long end of the yield curve. It could potentially dampen longer-term inflation expectations enough to create a bit more of a ceiling on some of those longer-term yields. Do you agree?
I mean, that's part of what, I mean, this is sort of the same argument that was made after Kevin Warsh sort of pledged allegiance to the flag of price stability back in June. It's just another version of that argument. Yeah, I mean, it would also mean that the Fed is trying to cool off growth, and that's why the long end would be coming down also. Inflation expectations, in my mind, look stable as it is. I mean, but that's, again, part of that is a function of reals continuing to go up because they're committed to price stability.
I guess I'd flip this on its head and say if the Fed does not hike rates next week, does that make you more bullish on going into an equity market that's re-rated on the margins over the past couple of weeks?
I think based on where clients are right now, where the markets are, I could see a scenario where if the Fed doesn't hike and people read that to mean that they're not hiking for the rest of the year, you could see the back end sort of keep pushing higher. Yeah, I mean, I think that there's something to that.
Neil, I know that we always talk about what's interesting on Fed decision days, how the market reacts to things. How do you think the president would react if we get a hike?
I think, again, that goes to Henry, the reason why Warsh should do it. He's got I mean, it's like, it would be like leaving your honeymoon early, right?
So not good.
Yeah, so I don't think if you're, I mean, what I've found very interesting is how deferential the president has been, right? I mean, I could see a scenario where Warsh hikes, and because Trump has a much bigger fish to fry at the moment, he kind of gives him a pass. By September, October, when you're much closer to the midterms, maybe he won't feel as forgiving. So again, that's another reason for him to get it out of the way now.